Well, thanks for joining us at Hong Kong Blockchain Week. Let's get right to the point. We've been talking about it. The world has changed irrevocably. It's hard to even say that word because that's where we are. What once was unimaginable is now pretty much every day in our daily lives. And then just to expand it to central banks and to policymakers, we're seeing the system pumping stimulus, driving down yields, that we're experiencing global economic uncertainty. Pretty much volatility is in bold and underlined. And what's really interesting, however, is the rise of DeFi amidst all of this. So let's talk about it. What's happening in this space, DAO or decentralized autonomous organization. Let's talk about liquidity pools, yield farming, and the external conditions driving it. We've got some great panelists for you and some introductions. I'm excited to be your moderator. I'm Angie Lau, editor-in-chief and founder of Forkast.news. We cover blockchain and emerging technologies that are shaping our world at the intersection of business, politics, and economy for professionals and you. And I'm joined right now, really thrilled to introduce them, Urszula McCormack. Hi, Urszula, dear friend, and one of Asia's leading blockchain and financial regulatory lawyers. And her focus on emerging technologies and financial crime really make her an advisory and thought leadership voice for not only governments, but for institutions as well. In 2018, she was recognized as a Financial Times Top 10 Legal Innovator of the Year award. So there you have it. We have a deep bench for you. Alex Mashinsky, of course, many of you know Alex. He's on his 8th startup company, Celsius Network, which you know has already raised 50 million in an ICO. He is a prolific investor, 120 VC investments himself. Alex, you've been busy. You hold 34 patents. You've raised billions of dollars for your companies, and about that much in exits. So it's great to have you on the show and to at Hong Kong Blockchain Week and to really kind of tap your brain about what's happening in this space. Miko, it is great to see you again. Miko Matsumura is a general partner with venture capital fund Gumi Cryptos Capital, is a general partner there. This is a $30 million venture capital fund focused on early stage blockchain startups. He's also co-founder at Evercoin, the safe wallet and cryptocurrency exchange. So we got 3 really great panelists here for this discussion. Okay, so guys, let's kick things off. What is DeFi?
Yeah, so I think Alex actually was kind of having some fun with that before we started the panel. So, I guess to me, the thing that's really interesting is this, right? Which is there's really broad DeFi and narrow DeFi, right? So narrow DeFi is really just Ethereum and Ethereum smart contracts, right? And it's really people seeking yield by offering liquidity into the contracts, right? So they're really so-called locking value Ethereum into these contracts, right? And that's narrow DeFi, right? But if you really think about broad DeFi, right? Broad DeFi is decentralized finance, and it's really a counterpoint to centralized finance. So if you think about it much more broadly, then it's potentially inclusive of things like Bitcoin, and it's inclusive of a whole bunch of things. And obviously people talk about DeFi going to other platforms like Tezos and, through Spark going on to things like XRP. And, so there's a whole bunch of different DeFis that are kind of starting to now emerge off of Ethereum. So, I think that it really depends on how people look at it. But, ultimately it's a bunch of nerds looking for yield. So,
Well, this is a movement that is they're also being joined by a lot of serious money looking for yield. And there's no doubt about that.
Yeah, absolutely. Yeah, I mean, if you look at things like compound finance, they're absolutely, it's a power law distribution of liquidity providers. So, there are absolute super whales in here. I think Alex had something to say.
Yeah. So first, before I jump into DeFi, I just want to say I think all of us in the crypto community should be thankful that if we're facing this K economy where the digital world is going up and up and doing great, most of the regular economy, the atoms and the anybody who's moving boxes or making anything is suffering through this. So I just want to recognize all those people, wish them well, and hope for the best, because I think for all of us, it seems like we're just sailing through it, but a lot of people are suffering and obviously are hurt from the COVID situation and so on. So I don't want anyone to forget about that, and we want to be as inclusive and supportive as we can. But jumping into DeFi, so if you read our paper from our white paper from 2017, we were one of 3,000 projects that were kind of like part of that ICO, Cambrian explosion of experimentation on the blockchain, right? It was like a second phase of innovation after Bitcoin and Ethereum and XRP and other chains have kind of showed us what is layer 0. Okay, let's figure out what's layer 1 or what's layer 2 is going to be here, right? So and we at Celsius, we focused on this yield, this idea that if the killer app for Bitcoin is store of value, the second wave of innovation is going to be all about yield. And I can tell you that a lot of people looked at us in a very weird way and thought that what we were talking about was completely crazy and that we will never be successful. And we launched the product in 2018. We started paying interest on, in the beginning it was 5 assets, and then 12, and then 25. Now it's 41 assets, right? So Celsius today supports more blockchain than any DeFi project on the planet, actually more blockchain than all of our competitors put together. And so for me, DeFi is not, are you fully decentralized or do you have one leg in the centralized world? But for me, DeFi is, are you acting in the best interest of the community? Are you delivering a service that cannot be provided by the banks? And right, that's why we're wearing these unbank yourself shirts. So because if we are fighting over bringing hundreds of millions of people from the centralized world, from the banking world into the decentralized world, they're going to come because of yield. Some of them can afford to come because they want this store of value on the Bitcoin, but most of them are going to come just because they want to earn that 5, 7, 10%. So I'm very excited. We were the first ones to offer interest in kind with paying Bitcoin on Bitcoin or Ethereum on Ethereum, and the first one to pay you with the token, right? So it wasn't Compound, it wasn't Uniswap. A year before all those guys, Celsius really invented the whole idea of DeFi. And I'm very excited that everybody's copying us, but we still pay more than anybody else. So my argument for all these guys who are, fudding Celsius is we pay 80% of what we produce back to the community. So if anyone wants to be better than us, show us that you're paying more than that. Show us you're paying 90 or 95%. And the only project I can point to say, yes, they do better than Celsius is YFI, because they effectively had no pre-mine and they don't charge any fees. And that's exactly the model that I think if all of us focused on that, improving the model, then we will actually bring hundreds of millions of people from the traditional finance world and make it a better world for all of us.
I mean, but Alex, I mean, by its very nature, decentralized means that there's just, as projects pile in, there is a new Wild West emerging. And for, Urszula, I want to bring you in here because, this is space that you've been in for a while, and you've seen regulators and policymakers alike look askance at some of these developments, and retrospectively at times start policing that way and restricting. Do you see, what do you make of what's happening in DeFi, and what are some of the reactions that you're feeling and you're conversing with in from a reaction from regulators and policymakers?
Yeah, excellent question. Well, look, DeFi now is, a really high agenda item at the international policy level, and a number of regulators are looking at it. There's countless industry fora now. It's almost a running joke that they're just mushrooming everywhere, and there's so much focus on this now because of, frankly, its potential, but also downside risks, I suppose, to the proverbial mum and dad investor, right? So, the critical aspects of that are the challenge that it poses to traditional regulatory models, which look for those sort of centralized actors who are, in fact, carrying on a certain business, brokering assets, custodying assets, all of that. And it really does strain those classic regulatory models. So we can talk about that in a little bit, but what I see across the industry is, a real spectrum of projects, and those that we would call, I guess, pure DeFi in terms of being completely decentralized or trust minimized. They use automation, use smart contracts, basically, as an inherent part of the way in which they operate, right through to projects that are called DeFi, but are actually more just sort of centralized finance projects, but with utilizing virtual assets. But I think it's that class that utilizes automation very heavily that is posing the biggest challenge.
One of the challenges consistently and persistently is KYC, know your customer. We have seen a lot of people get in the crosshairs, most recently BitMEX. And so in the DeFi space, how do you, and this question for all of you, both from the enterprise side and the policy side, how do you regard this attention, this focus, this issue, this issue of KYC, know your customer, in the DeFi space? Yeah, so I'm happy to be a bit of a contrarian here. For me, I feel like that's the place where it's kind of non-negotiable. So that one feels like, and this isn't my preference necessarily, but I don't think that I don't think FinCEN is going to take it easy on this one. And I don't think they're going to be excited about things like, oh, it's decentralized, so we don't need to do KYC. So I think it's going to happen. And, so I think if you're running a decentralized service, I think the precedent for that is Zach Cobain, who created Ether Delta, and the SEC basically went after him for a settlement, and they said, that was not KYC at all. It was actually running an unregistered exchange, but it absolutely had to do with, hey, he didn't even own Ether Delta anymore. He already sold it, and it was decentralized to begin with. So, at some level. So I feel like, they'll go after people associated with decentralized exchange, and whether it's even fair or not for them to do that, that's I don't think they're going to care. Yeah, I totally agree with Miko. I mean, again, at Celsius, we filed with FinCEN, we filed with the SEC back in 2018 when we just got started. Every one of our customers from day one was fully KYC. We could do continuous AML. So that's one side of the coin. The other side of the coin, and I'll throw this to Urszula just because she's the lawyer in the room, but take an example of a fully decentralized exchange, right? That runs half of the assets on any of those DEXs are centralized assets. USDC is a centralized asset. Wrap BTC is a centralized asset. USDT is a centralized asset. So let's say a court order comes out and freezes certain assets that are deposited one way or another in a decentralized exchange, and against that some anonymous person borrowed other assets, right? So now you have this conundrum of, okay, whose assets are safe and whose assets are not, who has a claim and who has not. So you have a tremendous set of new circumstances that have never been tested, at least not that I know of, that are really going to create chaos. So I think there is a completely legal way and compliant way to do what we are trying to do, and Celsius found that way. We squeaked our way through, even though everybody thought there was no legal way to do it. We're one of the very few institutions that never received a single action from a single regulator. We operate in 150 countries, and we stay compliant in 150 countries. So there is a legal way to do all of this.
But our industry somehow always jumps and says, no, we don't need any of that. We can just ignore all the rules everywhere in the world and pretend like all these rules don't apply to us because whatever, we were founded in Silicon Valley, or because we are registered on some island that no one knows where it is, and we can get away with it. So Urszula, you answer the question.
Yeah, well, look, so it's such a good question, and yes, I hear that all the time, and it's primarily from developers who are looking to deploy code, release code into cyberspace, and also code that might have multiple possible uses. It might allow people to form DAOs. It might allow them to deploy it in a way that generates yield. It could have multiple purposes, and the way that we look at that is, yes, okay, so let's look at it through the lens of the classic regulatory models. But then when I'm speaking to policymakers, well, actually, we need to look at it a little bit differently. So if I'm deploying code, and those cases, and some of which you mentioned, that they really hinged on the involvement of the developer in promoting it, in using it, in sort of tailoring it in a particular way. So we've got cases involving hacker software that was released, and the people who were found liable, generally for aiding and abetting a criminal offence, it was not because it fell into some sort of regulatory framework around hacking, but it was because they were there front and centre and they were involved. They knew the end outcome, and I think that's where we're going to start to see where, if it's a piece of code that, software that is, genuinely, super multi-purpose, then it's less likely that they're going to fall into any sort of regulatory net. The more and more targeted that it becomes, the more willing regulators are going to want to find a system to regulate it. And, we talk about the possible existing types of laws and frameworks that we might apply. Some people talk about, well, look, a gun in the wrong hands is illegal, but in the right, it's okay, but then some jurisdictions outlaw it entirely. What about 3D printers? What about even poppies, right? Poppies, we're discussing this, another group the other day, can be used for heroin. They can be used for incredibly powerful medicinal purposes. And I think that thinking around how we deal with, smart contracts, AI more broadly, is what we need to be thinking about for the more pure decentralized models. For the more decentralized ones, centralized ones, I couldn't agree more. There will be, certainly willingness to find actors who ought to be conducting KYC and, complying with all of their obligations around the world. I still see, documents that say this is governed by no law. It exists in cyberspace. We just saw Elon Musk say that, the laws of outer space might not, recognize Earth laws on Mars. So we still see this sort of stuff, happening, and I think we will for some time.
Well, he's one of the very few people on this planet that can escape gravity and live in space, and the laws will not apply to him. For the rest of us, gravity still applies, and we do have to domicile here or there and be governed by local laws,
But I think if you boil down to what law is, which is human civility, we should be tied to, a greater goal of just being good to each other, right? Law demands it of us to behave with that civility. And in this way, you can create a safe environment where people will feel safe and trust, the platform or trust the project and invest dollars. Without that trust, that growth is hard to come by, don't you think?
But it's not just to each other, right? It's the beauty of this network is that it's the consensus. It's the ability of all of us to get together and do what's in our best interest. The reason we always lose against the bank, because we always are one against the bank, one of us against the bank. If we all got together and pooled our assets and acted in our own best interest, we don't need the bank anymore, right? That's why you can unbank yourself, because the pool of assets can earn yield just like the bank earns yield on your own assets. So I think that when you see companies like PayPal or Line, who we partner with, bringing hundreds of millions of people into this industry, they want to bring it in a compliant way. They're not going to go for that fully DeFi, decentralized, no one is in charge way.
Yeah.
So we are so close. We are so close, and yet what do? We throw sand at the regulators and the people on the other side and pretend like we can get away with anything. So
well, and I
all
think
we
that,
have
you
to
know,
do-
yeah, look, I couldn't agree more, you know, and when we saw this during ICOs, and we advised on a lot of them, that, you know, you have people, everyone's got good intentions, but you do see some along the way, and it's this insatiable, desire to sort of make that money and get, we're seeing exit scams, we're seeing other scams in DeFi. And, you know, so when I talk to developers who are so adamantly against any form of regulation, you say, well, look, how do we keep those people out? Okay, you're pure intent. How do we keep them from spoiling it for everybody?
Yeah, how do you do that?
Well, I think that this is really the question, right? Because it's the question of externalities, right? Externalities are basically, I can take my cost and I can push it onto you without your consent, right? So that speaks to civility, it speaks to wealth inequality, it speaks to a lot of these really, really important kind of emergent themes that we've been touching, but maybe not diving into, and to me, I think one of the big promises of what I call open source financial infrastructure, you can call it DeFi if you want, is it's about really lowering the cost of infrastructure, right? And I think Alex made, probably the most salient point, right? Which is that, ultimately, what's the difference between kind of yield and not yield, right? Is ownership, right? So I call Bitcoin like the bank of the internet owned by the users, right? So in some sense, if you're a user, you're using it to store value, and the extent to which you're using it to store value is the extent at which you get the kind of dividends of the increase in the value of Bitcoin, right? So if Bitcoin becomes more valuable, you kind of get your share of that value, much like owning a bank, right? So to me, that's where the yield is coming from. It's coming from ownership. And, it's because people are disenfranchised and they're not owners, because that's why they're getting no yield. And, I think, Angela, you said something really intriguing, which is you were talking about how stimulus actually decreases yield, right? And if you look at like what the Federal Reserve is doing, they're slashing the prime lending rate to zero, right? But much like whack-a-mole, the thing that's so fascinating is that exact behavior is what's driving yield on the Bitcoin side, right? So the more
exactly
stimulus comes out on that side, it's like a whack-a-mole, right? So you whack this side and the other side pops up. So that's
well,
that's
we're just, at least in the US, right, we're borrowing from the future. We're reaching out to the future, printing dollars that belong to our kids or grandkids, and using them today to fill a hole that we have because we didn't save during the good days, right? So we spent everything we made during the good days on stock buybacks and dividends and whatever. And when we got into a pothole, we went to the government and the Fed and said, please bail us out. Look, there's a pandemic. Well, great. There is a bankruptcy court for that if you have a bad business and so on. So, but look, DeFi, pure DeFi is not any better, because pure DeFi, where the yield is only generated because newbies are coming and putting more money in, and you can sell them your token that you got basically at the lower price, that is not true value creation, right? I mean, like, again, the Celsius model is based on lending to institutions. Most of our money comes from exchanges or institutions who pay us interest, pay us yield, and we distribute 80% of that to the community. But the pure DeFi model does not have that real engine, like Miko was saying, the engine that generates value creation for Bitcoin does not really exist in pure DeFi. So we're still experimenting with different business models. We're still trying to figure out what works, what's not. And again, not to brag, but our token is up 3,100% this year, right? And it's not because we're part of DeFi. It's because we have a sustainable business model, right? So the what people don't spend enough time on is digging into the flywheel, digging into what's driving the stuff, and trying to understand, why is it working? Where is the yield coming from? Like Miko was saying, right? And then saying, okay, let me improve on that, right? Let me add a bell and a whistle, or make it run on this or that blockchain, or be more inclusive, or make it run on multiple languages and so on. So we're still struggling with what is a valid business model and what is not a valid business model.
Well, that is a perfect jumping off point. Let's dig deeper, just as you suggested, Alex. We've got a great panel to answer exactly this. Let's talk about DAO. What are some of the most interesting applications of DAO that you're seeing right now? with the potential that's emerging in your opinion? Miko, Urszula, Alex,
just a quick
you can all
one.
jump in. Yeah.
I'm a big supporter of Uniswap. I think Uniswap with automated market making mechanism is a great vehicle that kind of basically creates value for the market makers who are participants of the community, and basically provides a service to the people who actually want to exchange one asset for another. So I think that is definitely a sustainable, scalable business model. Now it has its ups and downs, and if you're using Uni, the value of Uni is very volatile, so we need to figure out what to do there, and it only works for the first 60 days or whatever, right? But we can improve on that, right? And you have impermanent loss that you have to deal with, that you have to really kind of think about how do we fix that. And there are other projects that are trying to deal with that as well. But there are some very good business models. I don't want anyone to come out of this and think, there's only one good one and it's what Alex is running, right? There's a lot of other good ones, but when we see a bad one, you see all that money rushing in, like Sushi Swap, for example, it's not going to end well. It's going to be a bad ending for the people who came late, and all these people are going to leave crypto. They're going to go back to fiat land, and it's going to make it so much harder for all of us to get to that mass adoption.
Yeah, when people don't feel safe, that they're just not going to trust you with their money. That there's no doubt about it. So you named a project. Let's think about it more broadly. What are the characteristics of a great DAO app or a great project? What are the characteristics of one that doesn't smell so good? Urszula, you probably, from a legal point of view, you probably have some good things to say about that one.
Yeah, well, look, I think this is where regulators will need to catch up, because a lot of DAOs really are collective investment schemes, so they are actually securities, right? But when they are not necessarily deployed by a centralized actor, it can make enforcement difficult, or they might not fall within the regime. But what I would say more broadly is that the connectivity, in the purely sort of virtual asset space, can work very well. At the same time, I query the quality of governance when it is purely decentralized without the necessary, perhaps, long-term incentive, long-term, investment. And so there's various techniques that can help with that, various sort of lockups and, minimum staking periods for certain aspects. I think all of those, so building in to the system and understanding that, that some are in it for short-term gain, and how you basically incentivize the best interests of that organization. So I think that's definitely a key, but really understanding that broader context in terms of potential legal implications of running it. So that's the key thing. But I think it's also important for us to sort of recognize that when Alex talks about value creation, one thing that's really important to recognize about DeFi and DAO is the value that's being created in terms of rethinking how traditional finance works. And we could spend a whole nother session on those learnings that will inevitably make their way into traditional finance. Won't necessarily replace traditional finance, but we're going to start to see a lot more of those principles creeping in, particularly as CBDCs and stable coins really gain traction.
That's really what's been exciting about all of these conversations. Some of the best fintech professionals in the world all headed to Hong Kong this week, virtually at least. And it's just the opportunity to, learn from the innovations that we're seeing in DeFi space, and how do you kind of almost take the best learnings, the best practice, and potentially, create innovation internally on legacy systems. That is a great list that you started with. Miko, do you want to add to anything to add to, what are the best characteristics of projects that really resonate with the community? And then what are the ones that don't?
Yeah, so, I just want to I know we're really short on time, and I know that, like, with this panel, it's obviously hard in this short a time to actually do reasonable service to a topic like DeFi and to go sufficiently deep. So, if I may, I'm just going to tell folks to, check out my show. It's Miko.com /bits, BITS. And, you know, I have a bunch of folks like Stani, the creator of Aave, ETHLend, and then obviously, you know, folks like Kane Warwick, who created Synthetics, and, you know, folks like Alex Mashinsky, who created Celsius, who we have here. So, you know, and Urszula, I'd love to have you on my show as well. So, you know, come check it out.
Okay,
that's how you get deeper into this.
Good pitch there. All right, let's talk about liquidity pools. You know, this obviously is also the crux of the question of DeFi, which is, as people flood into this space, how tamper-proof is it? How secure is it? Is it a Ponzi scheme? Is it, you know, how is it explicable that you've got 1,000% yield when in the real world and central banks are doing negative yield? You have to pay a bank to hold your money because central banks want you to spend it. You know, that's the monetary policy of the real world, and it's DeFi defying that in the virtual world. So let's talk liquidity pools here, and how should projects be thinking about it and doing it judiciously and doing it honestly.
So I'd love to lead off here, because I think Alex said something really interesting, right? Which is about kind of durable value creation, right? Because the thing that I think is super important is, you know, I think that Warren Buffett says, if you don't know who the sucker is at a table, then you are it, right? So I think the corollary in DeFi is that if you don't know where the yield is coming from, like, it's coming from you, right? Because, you know, basically yield, a large amount of the lost value yield comes from people getting wrecked, right? So, you know, they're aping into coins that have no value, you know, they're exchanging things that have value for things that have no value, you know, and so like this happens, right? And I think Andre Kranya, the creator of Wi-Fi, said that like it's money transferring from people who don't know to people who know. But like, that's, you know, that can't last forever. You know, I do think there are fundamental utilities that have been built that are, you know, valuable, but, you know, there are also a lot of things that don't fit the bill. So that's my read on it.
Well, I mean, Alex, go ahead.
Yep. No, I totally agree with Miko. He always manages to summarize it in such a great way that it's hard to go after him. You know, that's why I always try to jump in front of him to try to, but to add to what he said, look, there is definitely value here, and one of the reasons there is value is because if you look at M2 or the money supply and you look at the velocity of money, you will see that it's down dramatically, right? But when you look at the velocity of money in DeFi or on the blockchain, it's up. It's 10 times greater. It's not 2 times greater or 3 times greater. It's 10 times greater. And because of that, when you deploy money on the blockchain, it can earn much more. So like Celsius pays 10% on stable coins. That's 100 times more than your bank. 100 times more. Now, it's not because Celsius is 100 times better than the bank. It's because the bank is stealing from you 90% of the value they're creating with your money. So what we do need to do is we need to differentiate between the real sustainable projects, like Miko was talking about, the guys who are really in this to help you, who represent your best interest. One thing about Celsius that I can tell you that no other project in crypto can say is that we're not a neutral project like Uniswap or Aave or Compound. We only represent the people with the assets. Our job is to collect that asset. Now we have over 2 billion in collective assets from 215,000 people, and extract as much value as possible from the institutions. Again, each one of those people going against the institution will lose every time. But when we have 50,000 Bitcoins in our possession and we negotiate with the institution, we can get 10, 11, 12% to borrow these assets and deliver most of that back to the community. So that is a sustainable model. That is a sustainable model. What's not sustainable is when you create something that has like 1,000% yield, and everybody, while they're afraid, they go and put some assets and they hope they're not going to be the ones getting wrecked. And many of them do. And that's just not, it's not good for the community. It's not good for the developers. No one wins from that.
Yeah. Last question goes to Urszula. We've totally run out of time, but I gotta ask you this. We're talking about liquidity pool and safety. This is what you think about on behalf of governments. You think about this on behalf of regulators. You also think about this on behalf of projects. So when when it comes to actual money flowing in for projects and for people participating, what is the one takeaway that protects us all?
Just one. Well, look,
just
all
one.
a question of perspective, right? So for the developer, the key message is you've got to have that crystal ball. You have to think about where your project is, what environment it's going to be in 5 years, and really hit it hard from various angles. Hit it hard from the people who are looking for exploits. In your beautiful system, you need to look at it from a regulator standpoint, who's keen to clamp down on it, who's keen to stem the flows into your pool, and you need to be that sort of 5 steps ahead. So that's from the developer side. From the user side, the tricky thing is navigating, information. There's so much information out there, and the quality differs dramatically. So what Alex was talking about, differentiating between what is ridiculous style yield and what is reasonable, is still pretty hard. But then for those who are in the PE space, there really is a pathway to getting some good diligence on projects, and it's basically people who are in this space regularly will be able to smell a rat pretty quickly, or tell you the 10 things that you need to think about and look at very carefully. But yeah, looking ahead.
Looking ahead and educating yourself, that's a huge takeaway. And as Miko said, he is a great resource. Alex is a great resource, very vocal in the space. Urszula, I know that you're an incredible resource as well. And I hope to be a good resource for you at www.Forkast.news. But the ultimate resource and the big organizer to thank for this conversation is Hong Kong Blockchain Week. And it was great to see all of you, the panelists here, and all of you who are watching virtually right now, wherever you are. I collectively, on behalf of the panelists and the conference, we hope you're staying well, and we hope you're staying safe. It's a very volatile world, but knowledge truly empowers. So thank you all. It's great to be here with you.
Yeah.
Next year in person in Hong Kong. So.
Yeah, Hong Kong. See you there.
Thank you. Thanks.